On the 18th of May this year, Target reported. And when they reported, there was nothing wrong with top line guidance, and there was everything wrong with bottom line guidance. Essentially what they were suggesting is earnings were going to moderate quite significantly. They had a huge issue with inventory, and they need to discount that inventory into the future. On that day, the share price dropped 22%. A huge drop in just one day. Now, Target is not some speculative business. It's got a lot of non-discretionary revenue. It's been around for a long time with a track record of pretty decent capital allocation. However, they overbuilt their inventories and now they need to liquidate that, compressing their margins, and the market fairly reflected that with a drop of 22% in one day. So, is there some sort of metric like the inventory turnover metric? Would that be able to give us some sort of insight prior to the big massive drop that there were issues abound for Target? In today's update, we're going to break down the inventory turnover ratio, and we're going to find out whether we would have found clues by following this ratio as to some challenges that the business might have into the future with regards to margins and forward earnings growth. Let's get straight into it. We're going to break this down into two different segments. This is a very, very simple calculation. So segment number one, it's very important that we understand what the calculation is and what information it's giving us. Segment number two, we're going to go through a practical example. Earlier this year, around April, May, the Target came out. They had an issue with their inventory and the share price was down 20 to 25% on the day. However, what you'll see from the inventory turnover ratio is that all was not as well as it seemed beneath the surface. Now, this metric, when you're applying it to a business, is going to be very, very, very consistent with retail businesses, manufacturing businesses, those type of industries and sectors. Not every industry is going to give good insights when you're looking at the inventory turnover ratio. So it is going to be more specific to real goods essentially being sold, whether that's retail, manufacturing, etc. So that's a key caveat. We're going to use the example of Target because any investor in Target, if they were following the inventory turnover ratio, would have seen that there were problems a couple of quarters prior to the sell-off of 25% on one given day. Let's get straight into segment number one. Segment number one, inventory turnover. What is it? It's the cost of goods sold divided by the inventory. The cost of goods sold, you will find this on the income statement. And the inventory, you will find on the balance sheet. So we look at the inventory on a quarterly basis, and we look at cost of goods sold on an annual basis. And what that gives us is, it gives us a specific ratio or a specific number. I'll give you a very quick example here. Let's assume cost of goods sold for the prior year was $10,000. We find that again on the income statement. Let's say the inventory on the latest quarter is showing there's only $1,000 of inventory left. When we divide $10,000 by $1,000, we get a ratio of 10x. What does that mean? It means that the inventory turns over 10 times a year. So if you can think of it this way, the higher the number, or if it's trending higher, what does it mean? It means the company is selling at a faster pace and they're essentially turning over their inventory a lot faster. If the ratio is trending lower, or it pushes lower, or it is very low relative to its peers, what information does that give us? It means that they're selling a lot slower. It might be changing consumer preferences, there might be problems with operations, maybe there's over ordering, but the lower the number or the trend gives us some sort of indication that there might be challenges related to inventory that could give us insight into management's efficiency and or demand for products. So you don't really want to see a very low inventory turnover. You want to see an improving inventory turnover and possibly a very high inventory turnover to show that management are very effective with moving stock and of course sales are very good. Segment number two, let's go through a practical example. We're going to be using Target and we're going to be analyzing Target on Ticker Terminal. In my view, Ticker Terminal is the best resource out there for retail investors. If you're willing to do the fundamental work, you'll find just about every single data point you need on Ticker Terminal. We do have a link in the description, and I'd really appreciate if you would consider our link and support the channel. Let's get straight into it. Target, as you can see back in May, the share price for Target went from $215 down to $161. Significant drop in one day. That happened on their earnings. What essentially happened to the company was, it wasn't so much that they downgraded forward revenue growth, it was that they downgraded forward earnings growth. earnings got crushed. Why? It was essentially related to inventory. At a time where the consumer was pivoting away from spending on goods over to services, management were ramping up their inventory. Inventory turnover starts to slow down, and then you have a problem because you've got bloated inventory. How do you get rid of that inventory? You have to liquidate it. You slash the prices, slash the margins, and earnings compress. What happened to the share price? It got crushed. So the question is, if we were investing in a retail business or a manufacturing business that's very sensitive to inventory, would the inventory turnover ratio have given us some sort of foresight into that potential risk? And that's what we're going to be analyzing today. Using Ticker Terminal, whatever company you want to find, just key in the ticker at the top. I'm almost certain you'll find any company you want. I think there's close to 100,000 worldwide businesses here. Anyway, we're going to be looking at TGT, Target. When we scroll down here, you'll see a number of headings. We want to go to financials. Why do we want to go to financials? Because the inventory turnover ratio is a very simple calculation. Cost of goods sold divided by inventory. We want to look at the cost of goods sold over the past 1 year. And as you can see, the cost of goods sold trailing 12 months is $79.5 billion. When we pop on over to the balance sheet and we scroll down, you'll see as part of the current assets, inventory, which is $15 billion trailing 12 months. Now, one thing you can see here from inventory, it goes from 8.5 billion in 2018 all the way up to 15 billion. Not too far away from a double. Inventory has been increasing. That's not in and of itself a signal that would suggest that there's any risk, because the sales could be growing at a faster pace and the turnover ratio could also be increasing. However, that is part of the problem for Target in this example. When we pop on over here and we have a look at ratios, if we scroll down here, we'll see inventory turnover, calculated exactly the same as we calculated a moment ago. When we go look at this on a line chart, we go back through history, what you'll see is this is coming off of, if we look at this on a quarterly basis, just a little bit more insight. What you'll see is back in January of 2021, we peaked out for the inventory turnover ratio. Historically, that was at the higher ends. That was where the business was performing on all cylinders. However, unfortunately, in January 2021, that was actually the peak. And quarter in, quarter out thereafter, this continued to decline all the way down towards about 5.5. We went from 7 times turnover per year to 5.5 times turnover per year. What that suggests is that either inventory is growing at too fast of a pace or sales are starting to decline. In this circumstance, it was a little bit of both, but the 4 quarters prior to them downgrading essentially their forward earnings, we had already seen deterioration from the inventory level. That's how effective this can be. When we look at the share price, we pop on over here to overview, we have a look at the share price, you can see that this actually peaked in about November of 2021. If we look at it on a 3-year basis, it actually peaked in August of 2021, and it was sideways to slightly down since then. You had several quarters to recognize there was an inventory issue, inventory's building up, earnings slightly slowing down, or sales growth slightly slowing down, before you had to ultimately suffer a significant drop inside one day. So the inventory turnover ratio can be very, very, very effective in recognizing potential risks to the bottom line, profitability, because that stock needs to be liquidated at some point in the future. If you're interested, check out some of the other videos we have on efficiency metrics, such as the asset turnover ratio. Thank you very much for your support and have a great day.